Let's talk money.
Welcome back. We're discussing the mid-year outlook and the mid-year perhaps regime as you're evaluating your investment portfolios. What is it that you should keep in mind? And we're in conversation with Ashish Shanker of Motilal Oswal Private Wealth. Ashish has just told us that it is good to be very well diversified when it comes to your asset allocation, looking at the way markets are shaping up right now. So Ashish, let's now take it step by step. And you've given us a sense that you are going to be market cap agnostic in the equity space. So let's start there. I mean, maybe some funds for what it's worth in the large cap category and some in the flexi as well, which gives the fund manager the right to move wherever he or she wants to.
Right. So I think the first name that I took was Helios, right? Somebody who's been in markets for close to 3 decades, right? Is an excellent stock picker. Someone who believes that not committing mistakes is a way to create alpha. So I think a seasoned manager like that in this kind of a period will definitely benefit your portfolio, because it's a tricky pitch, right? I mean, you are hit with some news or the other every few weeks. So you need to ensure that your portfolio is positioned in decent quality names. At the same time, you know, you have some earnings tailwind as well going in the portfolio. So that's one name that I would definitely have in my portfolio. Then, of course, somebody who's, again, very experienced, believes in valuations a lot, which is the iPro Opportunities Fund. And it has a track record of creating alpha through sector rotation, right? And this is a perfect market for that.
And it's market cap agnostic.
It's again market cap agnostic. But this is a perfect market for sector rotation. If you look at the last 7 months, at the headline level, like you rightly mentioned, you know, Nifty's not done much, mid cap, small caps have also not done much at the index level. But if you look under the hood, right, there are sectors which have corrected sharply, there are sectors which have come back. And just to name 2 of them, defense has come back very sharply after a deep correction, and you have NBFCs which have corrected sharply. So I think a sector rotation kind of a strategy will work quite well in this period. The third fund that I named was the Motilal Oswal Large and Mid Cap Fund. Now, this fund actually blends in perfectly with the first 2 names. And I'll tell you why. Because of the thesis that a lot of the newer sectors are under the index. So if you look at the index, right, it's got the traditional sectors. And just to name 2 of them, banks and IT, where I believe that these sectors are fairly large now in terms of representation, plus earnings growth has been very, very slow.
They may not lead earnings growth.
These are tired sectors and they may not lead the earnings growth. A lot of the newer sectors are below the index, right? Whether it's renewables, digital, etc., etc. And Motilal Oswal as a fund has the track record of picking up high quality, high growth stocks and creating alpha. So actually between these 3 funds, you get a very, very good selection of sectors and stocks. And your ability to create alpha goes up quite sharply.
So great. Those are 3 ideas where you can be in a more or less market cap agnostic way. You give the flexibility to the fund manager to pick and choose across large cap, mid cap, and even small cap. But let's move on. For a lot of Indian investors, they love their mid caps, right? So they're wondering at some point mid caps have to start firing up, mid and small caps. Over here, which are the funds and the fund managers that you're liking now?
So in the mid-cap space, I think Edelweiss is one fund which has been very consistent in the mid-cap space. They've demonstrated consistency. They demonstrated the ability to pick stocks. I mean, they are basically running as per the GARP philosophy, growth at reasonable price. The quality selection is very strong. And then they also look at the valuation criteria. So that's one fund. The second fund, I would say, has been like the top performer over the last few years, which is again the Motilal Oswal Mid Cap Fund. They have demonstrated their ability to, you know, go through cycles in spite of a concentrated portfolio. Generally, you would find that the mid cap portfolios are very, very diversified. But this is a fund which holds 25 to 30 stocks and has managed to create alpha. So between the 2, you get a reasonable diversification in the mid-cap space. In the small-cap space, we have 2 recommendations. One is the Invesco small cap. Again, an experienced manager. Because in the small-cap space, you know, what is very important is you don't want mortality. So as you
companies dying out, basically.
Yes. As you go down the cap curve, quality becomes extremely important. Right? So I think Tahir is somebody who brings in that experience and attention of quality to the portfolio. So I think Invesco small cap has a good track record, and then you have the Bandhan small cap, again experienced CIO at the helm, which is Manish Gunwani. So these are some of the recommendations.
On the equity, on the equity fund
side.
Got that. So that's pretty helpful for those who are looking to add more money and looking at enhancing their equity portfolios. You have plenty of options to choose over there. Now, Ashish, hybrid funds. And, you know, we've been seeing that. I track the data on a monthly basis as well. Last couple of months, very steadily, hybrid funds are now pulling in as much money as, you know, pure equity funds. So clearly, investors are understanding the benefits of diversification. But how do you choose a hybrid fund? It's a very vast category, a lot of different types of funds. Aggressive hybrid, balanced advantage, etc. So where do you start?
Right. See, generally the hybrid funds are a stepping stone to mutual funds, right? People who are traditionally bank deposit investors or people who've just opened a demat account and now want to start investing through mutual funds, they come through the hybrid category, and advisors also often recommend that as the first stepping stone towards building a mutual fund portfolio, right? So in that category, typically people go with tried and tested. Okay, so one of the funds which is the largest fund and still doing extremely well is your iPro Balanced Advantage Fund, right? Which is more aggressive towards equity, but they balance the portfolio also pretty regularly. Then the second one is HDFC. HDFC is more aggressive than ICICI. So these are stepping stones towards getting closer to equity allocation. Then you have the multi-asset category as well, right? Within the multi-asset category, one of the smaller funds that we've recommended is Vitok, right? Which is true to label multi-asset. It's got gold, it's got equities, it's got debt. And even the debt portion, what they've done is partly, they've done it through the arbitrage strategy. So you get a taxation which is better. After 2 years, it's long-term capital gains. So these are few of the hybrid categories that we like. And then if you wish to be even more conservative, then you have the equity savings category, where you know, the equity portion further goes down.
It's more like debt-like returns.
It's more like debt-like returns. The risk is debt-like, the returns are debt plus. So that's also a good category. So
and any specific AMCs you like here?
So again, I think there, you know, you go with the bigger ones like an ICICI or an HDFC because they have track record in that category. So these are, and these funds actually come very handy in these kind of markets where the volatility is extremely high and you don't want to stomach that kind of volatility. For somebody who's not experienced and starting off investing, so on and so forth.
You know, speaking of debt-like returns, I wonder what your view is on REITs. It's a new asset class and again promises to be fairly steady but more tax efficient than even debt funds, which lost the pure debt funds, which lost that tax advantage. Is this an asset class you're liking?
Yes, for portfolios which are larger in size and people who can access, you know, the exchange, REITs definitely make a lot of sense. The only thing to take care of in REIT is the volatility in the near term can be much higher than, let's say, a conservative debt fund like a equity savings fund, because the asset, the prices move almost like equity, right? So you have to take a 5-year call. Over a 5-year period, you will be fine because you get the rental income on a regular basis. Plus, the asset value also stabilizes over time. But in the near term, based on supply demand, right, the prices can vary quite a bit.
So if you look at the REITs price on a daily basis, trading on the
can be very
exchange,
volatile.
then it could be.
It trades almost like equities, albeit less volatile than equities. So if you do not have the stomach for that, then REIT would not be the first category that I would recommend. Probably you come into equity savings or balanced advantage funds, and then the next step could be having a REIT portfolio. And if you take a 3 to 5 year view, you'll be fine. I mean, you'll get returns higher than equity, and you'll also get the tax advantage.
Understood, understood. So this is really helpful, and now we have ideas to choose from across all the different asset classes. So let's recap then. What is the final advice? And what would you say would be perhaps one or two of the big mistakes that we as investors need to avoid as we navigate these rather confusing markets?
Right. So every time, you know, we say the markets are different, but they teach the same you know, lessons. So if you look at last year, right, everybody was super bullish on small cap, mid cap, and a lot of people started investing in SME. Many people started going to IPOs, right? So ultimately, you know, when it comes down to equities, it's about buying good funds, good stocks, you know, staying for a longer period of time, having that patience going through volatility. So I think one big mistake that people probably would have committed, and now they are wiser, is going down too much on the cap curve, right? And buying these stocks directly, because a lot of these stocks don't have coverage, you don't have hand holding. So that's one mistake. Second is, going overboard on any asset class, right? So when equities were doing extremely well, people tend to load up on equities.
Yeah.
They tend to go overboard.
Yeah.
And then in markets like these, right, then you get a, rude shock on how your portfolio is performing vis-a-vis expectations. So I think, ensuring that you don't go down too much on the cap curve, take too much risk in frothy markets. Second is, sticking to your asset allocation. And in these markets, right, currently the markets we are in, I think the best thing to do is stick to the basics.
Keep it simple.
Yeah, things are tough. They will continue to be tough because I don't think this entire, challenge of what's happening globally on tariffs, etc., is over as yet. So we will see more of it.
Hunker down, stick to the basics, follow your asset allocation, and don't take on too much risk. So it's great advice. Thank you very much for putting it out so simply and beautifully for us, with some ideas, of course, of where we can be investing. Many thanks, Ashish. Great session as always. Thank you for joining us today.
Thanks, Surabhi.
All right. Well, with that, we're out of time on this edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. We will see you again next week.
Let's Talk Money